I'd like to welcome everyone to our webinar this afternoon. And first of all, I'd like to thank our sponsor, Treasury Strategies, for sponsoring the webinar event with the AFP of Arizona. We're looking forward to hearing from both Kathy, Greg, and Tony Carfang, Managing Directors at Treasury Strategies. Just wanted to take a few minutes this afternoon and talk a little bit about the Rocky Mountain Association of Financial Professionals. We are always looking for volunteers, and if there is someone out there that's listening that would like to be on one of our committees, please reach out to one of our board members or take a look at the website, and there's additional information on there. Or you can email our website as well, and someone will reach out to you. Also, we plan our events and topics well in advance, so be sure to reach out to a board member and get some information about any sponsorship opportunities. There are some upcoming Rocky Mountain Association of Financial Professional events. The September luncheon will be at the downtown Maggiano's on September 12th from 11:45 to 1:30. And the topic is on mergers and acquisitions, market updates. In October, we'll have an October roundtable, which the topic is cash flow liquidity management, and that one's on October 10th from 11:15 to 1:30 at the Denver Chamber of Commerce. So again, any information about the membership or the Rocky Mountain Association of Financial Professionals, please take a look at the website. And at this time, I'd like to turn this over to Jane, who is from the Association of Financial Professionals of Arizona.
Thank you. So Arizona is happy to be on this call with Rocky Mountain today. Thank you for inviting us and allowing us to share in this. A couple of real quick updates. Our organization, just like Rocky Mountain, is always looking for volunteers. We encourage you to look at our website, as we also have our different events listed and upcoming luncheons. And the biggest news we have is our annual conference is coming up on September 19th. We've got a great day of fun events and speakers. Just everybody ready to have a fun day. Some sessions are all planned out. We've got a couple of panels, one with treasurers, one is on women in finance. We've got sessions on technology, cash management. So looking forward to a really fun day. And then the day before, we're going to have a pre-conference cocktail party. And so we encourage everybody to go to the AFPArizona.org website, take a look at our events, and looking forward to everybody joining us.
Okay, so at this time, we'd like to turn this over to Kathy, and who will be kicking off the webinar. Again, thank you to both Kathy and Tony.
Well, thank you everyone for joining us this afternoon. We're happy to be speaking to you, and we hope that after the end of our hour today, everybody is going to come home with a couple of ideas for finding the value in your account analyses. Just let me go over a couple of housekeeping things first. Oh, by the way, this is Tony and this is Kathy. We're managing directors at Treasury Strategies, a division of Novantas, and we run the corporate treasury services group here at Treasury Strategies Novantas. Our presentation today, we have a PowerPoint deck that everyone who's on the call will get. We'll do an email afterwards, and we'll email you a copy of the deck, and we'll also email you a link to the recording of our presentation. We're recording today, so if for some reason you want to go back and listen to it again or share it with some other people in your organization, you'll have that link to do that with. You'll also get a CTP sheet after the presentation that will be sent to you. Now, while we're doing the presentation, if you have questions you want to submit, there's a little Q&A box in the center of the bottom of your screen down there. So just click on that and you can type us a question. And if we're good at multitasking today, we can read the question and try and answer it on the fly here. But if we're not good at it, we'll send out some answers to the questions when we're done also. Okay, so I think that's our background. We wanted to start out today with a polling question, so we can see how everybody's dealing with account analyses already. And I've just got one polling question. There are 5 possible answers here, and you can click as many as apply to you. So if you do more than one thing or think more than one thing, go ahead and click a couple of times. And while you're answering the poll, I'll talk a little bit about today's agenda. So to begin with, we're going to talk about some current market practices. We've done a couple of research studies that deal with some account analysis questions, and we're going to share findings about those with you, as well as findings of our poll with you. Then we're going to talk about what your goals might be if you want to have, you know, sort of an organized approach to getting value from our account analysis. We're going to talk about some basic goals and some more advanced goals. And then we're going to kind of get into the meat of what we are learning as we spend more and more time with our customers using account analysis tools. We'll start with ECRs and rates, which is a hot topic for everybody given the rate environment we've been in for so long and what's happening now. And then we have for you 4 use cases, which are 4 examples of how you can actually get value out of examining your account analyses and using them to do data mining. And from those 4 use cases, we hope that you can take away some ideas or generate some ideas of your own about how you can get some value here. And finally, we've got a special little offer at the end of our discussion, which everybody needs to stick around for because it's really good. Okay, so how's our survey going here? Let's see. The vast majority of you eyeball your account analyses. Over 50% of you said that as an answer. Another 30+% say you use spreadsheets. About a quarter of you say you don't review them regularly. It's just a cost of doing business. About 20% say you use some kind of third-party tools. And 5% of you said you wish you had better tools. That's really fun because I was figuring lots of people would say I wish I had better tools. When we talk to people who are clients who work in the account analysis area, boy, so many of them say that messing with the data is the bane of their existence, that if they could just, you know, offload that part of the work and have a better tool to get the data shipshape, then they could spend their time analyzing it. So this is good. Okay, our agenda I just went over, and so now we're going to talk about current market practices. All right, so this is information from a survey of 135 U.S. headquartered companies in May of this year, so it's very current information. And we asked them about what they did with account analysis, and the overwhelming majority of them say they review their bank fees monthly, and a couple do it less frequently than that. So we can pretty much say the whole world looks at this stuff monthly. And what do they do to look at it? The same question we pretty much just asked you, although most of them said they use spreadsheets. Just about half of them said they use spreadsheets, and another 20+% said they eyeball. So that's a little bit different than our group on the phone here today, but those were your top 2. That's what we got in our survey as well. And then you have a total of about 25% that say they look at their account analyses through their treasury management system or through some kind of third-party tool. And looking into that a little bit further, these third-party tools, what is it that they use? So again, the vast majority of them don't use a third-party tool. That's that big navy blue 3/4 of the pie. But 15% of the people in our survey said they either use BRM Fiserv as a tool or In-Depth as a tool. And for full disclosure's sake, In-Depth is the product that Treasury Strategies develops and offers. And then another 10% use all other. There was lots of them, you know, where we had one or two maybe mentions of each, so we just consolidated them. All right, so that's that. And then finally, external benchmarks. Everybody that we talk to wishes they had good external benchmarks. In fact, in another survey that we do, this one was from the beginning of the year, we call it the State of the Treasury Practice Survey. We do it every year. We usually have 400 to 500 respondents in there. For the last several years running, getting benchmarks on bank fees is the #1 topic that people say they wish they had benchmarks for. And here we see that most people don't have benchmarks, but those that do have benchmarks get them either from Phoenix Hector out of in-depth, and then there's a teeny little sliver that get them from somewhere else. So there aren't, you know, really, there aren't a lot of good sources for this. And it's very, very helpful for analyzing your bank services. We'll see that in a minute in more detail. Let's talk for a second about what your goals might be if you want to have a methodical approach to getting value out of your account analysis. So #1, you could have just some basic goals. And these I think of as sort of the minimum acceptable things that Treasury should be doing with their account analysis. Do our fees look about right? I mean, you may not have time to go through all the line items or get into any depth, but at least you can look every month and see it's about the same as what they charged me last month, and I can be comfortable in that. If I see a spike or a real drop, maybe I've got to get into it. But if it's running fairly consistent, I can be a little bit assured. Secondly, are my balances tracking with what we target them to be, or are they materially higher or lower? Either something much higher or something much lower could be a signal that something's wrong. But again, here, if you're running in a consistent fashion, tracking with your, you know, your historic norms, that can make you feel comfortable. And finally, is there anything obviously wrong with what I've gotten billed for this year? You could turn that up in either your thumbnail of bank fees or of balances. Now, there's value in here beyond just knowing that stuff. And here are some possibilities, examples. There are a lot of possibilities that you could think of for your advanced goals, but competitiveness. Are my fees competitive and are my rates competitive? This is a question that many Treasury people are asking. They don't necessarily feel like they have to have the lowest prices of anybody or the best rates of anybody in the country, but they at least want to know that they're in the market, you know, that they're no worse off than the average. And certainly we'd all like to be a little bit better. Another goal might be, are all these services actually still needed that we're buying? You know, did we outgrow some things? Are we double buying some things? Is there stuff we have that we don't really need that we're paying for? Why pay for paper copies of anything? You could have one of your account analysis goals be to analyze the opportunities to really move away from paper. And finally, am I leveraging technology as well as I should be? Okay, so with that as kind of the background of what your goals might be, Tony's now going to shift in and talk about everybody's favorite aspect of account analysis, which is ECRs and rates.
Thank you, Kathy. So on the top part of your account analysis, you usually see some breakdown of your balances and the credit that you're getting on your balances. Obviously, it's important to deploy your balances as efficiently as possible, and for those balances that you can't redeploy, you want to make sure you're getting as high a return as possible. And the way that typically takes place is through an earnings credit rate. That's the allowance that a bank gives you to offset your service charges. So here's an example of how you might analyze your earnings credit rates from your account analyses. The horizontal axis shows balances in the accounts, and the vertical axis shows the earnings credit rates. The red line here is the median. This is the median of all of the companies in the marketplace who are utilizing, who are clients of Treasury Strategies. The top blue line represents the 75th percentile. That means 25% of all companies are getting an earnings credit rate that is above that top blue line. The bottom blue line is the 25th percentile. That means a quarter of the companies are getting something less than the top, than the bottom blue line. And half of all the companies who are Treasury Strategies clients are in between those bands. So it's very useful to look at the earnings credit rates you're getting in light of these benchmarks. A couple of things here. You can see how it's actually rather obvious, but this illustrates the point that the more balances you have on deposit, the more likely it is that you will get a higher earnings credit rate from your bank, which means that if your deposits are spread out across a lot of banks, you may be on the left-hand side of this chart, whereas if you were to consolidate your balances, you might end up further on the right and get a higher rate. Also notice that the distance between the blue lines, where half of the market resides, is pretty wide, which might indicate, depending on where you fall on this, that there's an opportunity to negotiate a better rate for yourself. Now, if you notice, let's say at the $10 million point here, the red line intersects at about 43 basis points. So in the second quarter, based on our benchmarks, the average earnings credit rate on a $10 million balance was about 43 basis points. If you were getting 43 basis points, you were getting the median earnings credit in the market. Well, we want to point out that that is below external money market rates, but again, there are a lot of reasons why you would keep this money at a bank. Final point I want to make here is these are based on collected balances. That's so in your account analysis, you might see a top line that says ledger minus float, and after all the float is subtracted, you get a collected balance, and that's where the earnings credit rate is applied. Now, there's another line that you'll see, and this goes by a lot of different names at a lot of different banks. We call it a balance assessment fee because that's what it is. Some banks will call this a recoupment. Some will call this a regulatory recoupment fee. Some will call it a federal charge. This is what used to in part be FDIC insurance that banks would pass through to their customers. However, beginning about 5 years ago, that practice changed, and so banks are now assessing with this balance assessment fee to help them recoup the FDIC premiums that they're paying on the deposits, and they're paying those on all your deposits, even though you're insured up to just $250,000. There are also capital charges, liquidity charges they fold in there, a wide range of things that help the bank meet its various regulatory and capital requirements. Notice how wide these lines are, and sometimes they're as low as 5 basis points and as high as 40 basis points. Now, the median is pretty flat at around 15 basis points. Most banks charge somewhere between 12 and 18 basis points. However, this is based on ledger balance, not collected balance. So unlike the earnings credit rate, this is based on a bigger number. This includes float. And as you're looking at this every month and figuring out what credit you're getting from your banks, it's really important to not simply subtract the balance assessment rate from the earnings credit rate and say your net is A minus B, because A and B, those rates are applied against two different balances. We'll have a little bit more on that later. Now, when you do correctly net out the balance assessment fee from your earnings credit rate, you really reach the bottom line, which is what we call the net effective rate. This is what you are actually earning on the collected balances that are on deposit at your banks. And you can see, remember we mentioned earlier that the earnings credit rate intersected the $10 million mark at 43 basis points. Well, here it intersects at 26 basis points. So you can see how the net effective rate is lower, and in some cases substantially lower than the earnings credit rate. Now, to give you an idea of how rates have changed, and you may have read that as interest rates have gone up, bank earnings credit rates have lagged. or have not gone up nearly as fast. There are a lot of reasons for that, but this graph shows you our second quarter 2018 benchmarks as it compared against the fourth quarter of 2017. And you can see that, the red line is where we are now, or the quarter that we just finished, and the blue line is where we were at year-end 17. It's interesting here, the biggest increases are at lower balance levels. And even though there have been several rate hikes, at the highest balance levels, there hasn't been much of a rate increase at all. Now, that probably tells us that companies with the biggest balances had already negotiated higher rates with their banks as rates started to rise, a year or two ago. And now the banks are sharing that rate increase with customers who have lower balances. And again, knowing what the benchmarks are helps you understand whether or not you're receiving a rate that's commensurate with your balance level. A couple of other interesting little factoids here. On this chart, we're comparing the earnings credit rates offered by the largest 4 U.S. banks versus all of the other banks that our Treasury Strategies consulting clients and in-depth clients are using. And what's fascinating here is the blue line are the largest 4 U.S. banks, and on balances of below about $8 million, the biggest banks are offering higher earnings credit rates than everybody else. But at balances of over $8 million, the regionals and the local banks seem to be offering a much more attractive rate. It's just fascinating to observe. And you may want to compare yourself to these numbers and see where you are and adjust your balances accordingly to impact your bottom line. Now, how do these earnings credit rates compare to the market? And we have an example here for the healthcare industry. And we're showing this to illustrate 2 points. One is it's possible to benchmark at an industry level and not just an overall market level, and this is what our healthcare clients observe. But the other point is that the bottom blue line is the are the net effective rates that we see in the market, just like you saw on an earlier chart. The top red line is the average rate on an institutional money market fund early in the second quarter. And the differences are very wide. Now, as I said before, there's a lot of reasons why that's the case. You have transaction balances that you need to facilitate your daily cash flows. You have late arriving funds. You have money that just not cost effective to transfer in and out, throughout the day. But just to give you an example, at the $10 million level, if the difference between the net effective rate at $10 million looks like 20 basis points there, versus the money market rate, which is 180 basis points. That's a difference of 160 basis points that you could pick up if you were able to harness those balances. That works out to $160,000 a year bottom line impact. The difference between an earnings credit and a money market rate. Now, over the course of the interest rate cycle, these lines move and they get closer together, and one may be above the other. So it's important to look at these regularly. And it's not just a rule of thumb that says it's always better to move into a money market fund, or it's always better to keep a bank deposit. This is something that you have to manage. Now, as Kathy mentioned, we're going to be discussing several account analysis use cases. But before we get into the details of the use case, we'd like to show you what an analysis dashboard might look like, what you might be thinking about putting together every month from your account analysis statements. And as you can see on the top part here, a simple summary that shows for each of your banks what your collected balances are, what your earnings credits are, your total services, and then your bill, your excess or deficit earnings. Obviously, you want to look at outliers. You want to look at anomalies. If you look, for example, down the earnings credit rate, the calculated ECR column here, you find that you're only getting 5 basis points at Tri-Central Bank, where you have $6 million on deposit, and you might want to say, hey, what's up with that? Looking over one more column at your total service charges, this shows that you're spending about $30,000 a month at both Mustang Bank and Western First. And the question there is, does this pass the sniff test? Is this, are they your 2 largest service banks? Again, as a dashboard, what you want to do is be able to simply eyeball and make sure everything is running smoothly. The bottom set of bar charts is a way of looking at how your business is allocated across your banks, and this is important for many of our clients. The blue bar is the allocation of credit across the 5 banks. In this example, the orange bar is the allocation of bank services, and the red bar is the level of collected balances. So if you look, for example, under Mustang Bank is providing only 10% of your credit, but they're receiving 40% of your service charges. So you might look at that and say, is this what I really want this to be? Or do I want to spread it more evenly? Or if you move to the right at Tri-Central Bank, they're providing 40% of your credit, but only getting 8% of your services wallet. Again, is this by design, or is this something that you want to remedy? So the idea of the dashboard is to give you a feel. A second page of the dashboard might be a time series that shows your service charges, your balances, and your earnings credit rates by month over the past year, or however long you want. And again, the idea is for a dashboard, you can easily eyeball it. If you look at your service charges by month, you can see those lines are fairly stable. There's not a lot of jumping around. The middle set of bars, the balances by month, that blue line there, Tri-Central Bank, seems to jump around. Is there some reason why it's more difficult to manage to a stable balance level Tri-Central than the other banks? Might be an interesting question. Clearly, on the bottom chart, you might get the answer to that question, which is that Tri-Central is paying a lousy earnings credit rate, and you don't want to keep any more balances there than you have to. Another final way to look at a dashboard is to look at the allocation of services. One of the things we advocate at Treasury Strategies for our clients is to take all those little line items and roll them up into what we call product families, and then see how they distribute across your banks. And again, from a dashboard standpoint, the question is, does this pass the sniff test? So we see the pink over here is actually lockbox services, and this shows that 24/7 Bank and First Digital do the highest share of your lockbox services. You wonder why a digital bank is processing lockbox paper. That's a separate question. But you say, okay, so are these my 2 lockbox banks? Does that sound right? The gold, Western First and Mustang Bank, are the wire transfer banks. And again, and we've actually sat with clients and have seen some surprising questions from the treasurer that says, well, wait a minute, I didn't realize we had any lock boxes at Western First, and someone says, well, you remember that division we acquired? We never closed that lock box. Well, maybe we should. So anyway, these are examples of some of the things you can see at a high level just by looking at a dashboard. Now, Kathy is actually going to start diving deep into some very specific examples.
So here are the 4 use cases that we're going to go through for you. And I hope you'll track with just the kinds of questions we're posing, and it's all very hypothetical. There's no clear answers really in these examples, but we wanted to give you some sort of guidelines for how you might go through your account analyses and find some strategic value. So the first example is, are prices reasonable? This is a logical question on most people's minds when they get into their analyses. And I'll start this by saying the goal is not to run around here looking for nickels and dimes. We're trying to think a little more strategically and see if there are opportunities on pricing to make meaningful impacts. So the first thing we want to do in looking at this is consolidate all of these many line items that show up on your analyses into product families. That's a foundational concept of how we go after finding the value here. You can't possibly look at 100 line items every month, and even if you just picked out, the 10 biggest ones, you're still probably not really getting a representative picture of what those services cost from bank to bank to bank, because how they break out their charges even in the same product family and how many different line items they have and how they price those line items, it all varies so much that if you're just looking at one line item, you're not going to get a good picture. So we want to identify all of the product families and then put the service codes into product families. And we do that in our, in our product in-depth. We've identified 9 key product families, and we map everything into those 9 product families. So our example here on this page, we're showing you for First Digital Bank the 3 line items on their analysis that show up in the funds transfer or wire product family. Now, you'll also notice the little stars on incoming and outbound wire. Those are another key aspect of this. You have to be able to count things properly. And a little star on our reports means that we've identified it as a volume counter. If you took, for example, a lockbox service and you counted the checks deposited, the items processed, the extra photocopies, the staples, the data capture, the packaging, the mailing, if you counted all of those activities, you'd end up with like a bazillion more items than they actually really processed for you. You have to find the small number of line items that really count properly. So once you know what that is, once you know what all the line items are in that product family, you are making some serious progress. And that is that you'd be able to compute per item costs for each product family. And this is what we want to compare from bank to bank. I don't care that 24/7 Bank has 15 items that map into lockbox and First Digital Bank only has 2. I don't care about that. What I care is that both are lockbox. I've got all the items. I've got the right volume counters. So here for that example that was just on the previous page, for First Digital, for the wire or funds transfer product family, we have a volume of 66. All of those services together added up to $1,386. So dividing those two, we figure out that the average cost per wire is $21. And now we're in a position, if we do that for all of our banks where we do wires, we can do some comparing. So on this slide, I'm showing you, I'm missing, somehow I lost a circle. I lost a pink circle at the bottom there. Anyway, the pink circles are circling the product volumes, and I should have had 4 of them. The turquoise circles are the prices. And these are my 4 banks where I do wire. So now I'm just really literally comparing apples to apples on wire charges. And the first thing I notice is, wow, I've got a pretty wide variance across my 4 banks in terms of the average price. I go from something like $13 to $21. That is a huge variance. And if I'm paying attention now to what's in the pink circles, that missing one at the bottom would show me my bank where I pay $17 a wire, I have 1,200 wires. And the bank where I pay $16 an item, I have 1,100 wires. So my biggest wire volume banks aren't even the banks where I have the lowest price, which Tony was showing you, yeah, what's up with that? Tony was saying, the more volume you have, either the better the rate or the better the price you expect. That's not happening here. So the next thing I want to ask myself, so I'm saying, this is interesting. I could have somewhere to go here strategically, but before I figure out what to do, are these prices in line with the market? So we look at how they compare to the benchmarks. Now these blue and red lines are exactly comparable to what Tony showed you on ECR, except they represent prices for services as opposed to ECRs for balances. And it's the same above the blue line. The top blue line is the top 25%. Below the bottom line is the bottom 25%. In between the two bottom lines, 50%, etc. The stars are my banks, my 4 wire transfer banks. And you can see that those 2 stars out on the right are the highest volume banks, where I have over 1,000 wires per month. Those are pretty high price banks. I am well above the 75th percentile for wire transfer prices. So yeah, I have wide variation in my prices, and unfortunately my 2 biggest volume banks are the highest price banks. So what am I going to do about that? First of all, what it says to me is there might be some potential here just in negotiating price. Maybe I can consolidate some volumes. I don't know, but when I do the math, oh, let's go to the next slide. When I do the math, if I could lower my 2 highest price banks for wires down to the lowest price, that would save me $100,000 a year. All right. Now, I'm not sitting here saying I think I can get that, but I am saying that's a big enough sandbox to make it worth playing in a little bit. You know, if I only got 75% of it, I'd still be saving a lot of money. So it's worth looking at. It's worth trying to reduce my wire prices. I ought to be thinking about also, should I move this business? Should I put all the business at one bank, the one that has the lowest price, or should I try to negotiate price where I'm at? You have a lot of questions to think about with that question. There might be credit relationship impacts. You might really need some of that business at First Digital, and you don't want to move it out. There might be operating reasons that I'm keeping that business at that bank. And I might have to do some programming or, you know, other changes to my accounting system if I'm going to change my wire banks. But maybe I'm not going to have to do any of those things, and maybe I've got free reign to move, so I should be looking at it. I might also be asking myself, hey, with all these wires I do a couple thousand wires a month. Maybe I should switch to ACH, and those are only 30 cents an item. Okay, so here's a way to use your account analysis data a little bit more strategically. All right, second use case, product allocation across my banks. Tony actually already teed this one up. Those little pink slices on my pie charts are lockbox. And you can see I have 2 big pink slices at 24/7 First Digital. I have a teeny one at Western First. Why do I have that little bit of lockbox business hanging out at a third bank? And a bigger question might be, do I really need 3 lockbox banks? I mean, what is that costing me? Why do I have that bank? Well, that's the first place to go, is why do I have that bank? Maybe it was an acquisition that we made years ago and never got around to closing it. Maybe it's a legacy bank relationship of some sort that's very important to us and we don't want to get rid of it. But again, maybe I have free reign to look at it. So similar to the last use case, I'm going to look at volumes and per item costs across these 3 banks. And here I see that my unit prices are really pretty tight. $1.25, $1.18, $1.55, pretty tight. But my third bank down there, Western First, as I already noted, teeny tiny slice, I just have a little bit of volume there. So could I move that business? And what would be the value to us of moving that business, especially if I'm not likely to get much in terms of price improvement? Once again, though, let's check lockbox prices at my lockbox banks against the benchmarks. And here, I'm in exactly the opposite position I was on wire transfers. All of my banks are below the 25th percentile. So I'm in a really good spot price-wise with all my banks. And it probably means even if I can consolidate some business, I might save a little bit, but I'm probably not going to save that much. So if I'm going to pursue consolidating this business, it's got to be for some other reasons. Is it worth trying to push all this business into 1 or 2 lockbox banks? Well, what are some of the possible benefits? Well, A, my balance management could get a whole lot easier if I only have collections at one bank. What's going on in accounting as they're applying this cash? that could be a real improvement. Might be greatly beneficial to them to just be taking a feed from one bank instead of taking 3 slightly different feeds from 3 slightly different banks with 3 operating groups that can make mistakes on any given day. Maybe one of my 3 banks offers really a better service or better features. The one area I don't think I'm going to get much benefit is on my price. But there are negatives to this too. There's a lot of effort at changing lockboxes. Customers are disrupted. You have to be after them to get them to change their addresses. Again, we might have to think about credit relationship impact. So even though it isn't cut and dried, there might be still some good operating benefits for moving this business into 1 or 2 lockbox banks. All right, third case, Tony, balances.
So our next use case is getting more value out of your balances. And if we look at the following table here, what we see, this is a way that you might want to lay out your spreadsheets or look at things on whatever tool you're using. But if we look at the credit, the collected balances across the top, and then the earnings credits and the balance assessment fees that we talked about earlier, to see what net we are getting at each of our banks. So let's take the middle column here, Mustang Bank, where we have about $5.5 million. We can see from our account analysis that we're getting $2,050 of earnings credit. We're paying a balance assessment fee on our ledger balances of $860. So net we are getting a net credit rate of a net credit of $1,190. That divides out, continuing down the column, to an earnings credit rate of 46 basis points, a balance assessment fee based on collected balances of 19 basis points, so a net of 27 basis points. So after all is said and done, your balances at Mustang Bank are earning 27 basis points. Now let's look across that bottom row, and lo and behold, at First Digital and at 24/7 Bank, your net effective rate is actually negative. It is costing you money to hold your balances at the bank. And at First Digital, it's negative 67 basis points. You're losing almost a full percentage point there. Obviously, when you see something like that, that's something that you need to investigate. And it may well be that the timing of your deposits at First Digital, the cutoff at your lockbox, for example, something as simple as the cutoff time could be causing more float to reside in your account than is necessary. And as I mentioned, you're paying the balance assessment fee on the total ledger balance, including float. So this may actually be controllable by you, have nothing at all to do with your bank. Looking across, you might look down at Tri-Central and seeing that you're earning a 5 basis point earnings credit rate. You're paying a 5 basis point assessment fee, so you're ending up with nothing on the $6 million there. And maybe that's fine, or maybe you ought to think about moving that money over to Western First, where you can earn 43 basis points, which is the highest of your net effective rates on this page. So this is a simple example of simply how to lay it out. And again, as Kathy pointed out, before you do anything, you want to check this against the benchmarks. And in these cases, we can see that those 2 lowest banks that we saw before actually have rates of below 0, but your 2 other banks, Western First and Mustang Bank, are above the benchmarks. So as you look at this, you might want to say, okay, everything below that bottom blue line is something that I need to investigate. So as you're investigating, what kind of things might you be able to do here with all the balances that you have at your bank? Perhaps if you can get your arms around that, you could take half of your balances and pay down some of your short-term debt. And again, on a $10 million balance at a prime rate of 3 3/4%, that could save you $400,000 a year almost. simply taking half of your balances and paying down some of your debt. Perhaps you could move some of this money outside of the bank or through the bank. You can move it outside the bank into a money market fund or within the bank to an interest-bearing account and if you can earn an extra 1.5% there, that's worth $150,000 a year. Moving your money across banks to get the highest net effective rates, we already discussed. Then finally, just having an open discussion with your bankers about the earnings credit rates and the balance assessment fees. A, you might be able to negotiate that, or B, you might be able to understand what kind of things are under your control that could lead to lower float in your account and therefore a lower balance assessment fee, or more stability and predictability to your balances. And banks may pay a premium, particularly under current Basel III regulations, for stable balances. So there's a lot that you might be able to do here. So that was our third use case. The fourth use case is examining variances. And again, from all the line items on your account analysis, there's a lot of stuff that can make you go blind. But if you align the stuff properly, this is a very simple example. If we look to the second to the last line on the page, which are outbound wire transfers. And we see in this particular example, in May of 2018, there were 232 outbound wire transfers, but in June there were 521 for a net additional cost of almost $6,000. So you say, well, what's up with that? Why do we have an extra 300 wires? And if a big variance like that if the answer isn't obvious to you, then that probably means there's an opportunity to figure out how to save some money here. For example, if you investigate, you might find that your payables department was backed up, and then to avoid late charges, they had to wire out the money, and because somebody was out sick for a couple of days. It could be something as simple as that. You might also ask the question, why are we doing outbound wires at all when we could be doing ACH? And if you look further up the line, ACH is 8 cents. Wires are $20. So that's another question that you could ask. The variance of 300 items, the difference between the 232 and the 521 this month, is almost $6,000 a month or $70,000 a year. So something as simple as getting a spreadsheet set up like this based on all of your account analysis data, and then some macro to highlight in red the biggest changes, lets you eyeball this and immediately find, like in this case, what might be a $70,000 a year savings. So that's an awful lot to get your head around here, but by organizing the data properly and looking at it in a structured way, month after month, just in this simple example, on these 4 use cases, I think if you add up everything that Kathy and I suggested, we're talking over, $1.5 million a month of savings potential just from looking at what looked like a really simple account analysis.
Tony, on this last page, I just want to say many of these things are sort of things that you do one time. But when it comes to looking at these variances, so many of our in-depth customers talk about the variance reports as being incredibly helpful to them. And I think the reason they are so helpful is that Treasury people can't always see what's going on in accounting, in the operating units that generate some of these transactions. We don't know in Treasury that accounting was backed up and they sent out a bunch of wires instead of paying things the way they normally do. We don't know that there's some big deal closing necessarily, and people are wiring money all over the place, and they have the authority to do that, but it results in a big spike. We don't know that someone ordered new checks and they never got tested, and they're bad paper, and as a result, it's jamming up the machines at the bank, and I'm getting rejects right and left.
$20 reject charges.
We don't know that people are bouncing checks right and left either, and we're getting all sorts of, that's why we're getting NSF charges. So the variance report helps you really get a a bird's eye view into things that might be happening in areas you don't normally interface with, where problems can be occurring. I just wanted to mention that. Okay, so.
Kathy, we have a question from the audience here, which is, how is this monthly data input into the spreadsheets? Is this manual, or like how can we do all the things that you just talked about?
Wow, what a nice question. Thank you. Some people do build a spreadsheet. They couldn't build one that's probably as complex as we've had and enter it manually. In our service called In-Depth, we have technology that reads electronic, either 822s or electronic PDFs, and uses automated intelligence. We've trained our software well, so it uses automated intelligence to put all of this line item detail into the right spots, automatically create all of these reports that you've just seen. It is really very, very slick.
Now some people also get EDI files from their banks and usually have that transmitted into their Treasury workstation or into a third-party tool. Kathy mentioned In-Depth. We saw in some of the earlier charts, Fiserv has a service. So there are ways of getting this data either electronically in an EDI file or a PDF file, and have those automatically read in and formatted.
Okay, so we hope that this has given you some good ideas for what you can do in getting value from your account analyses. And hold on just 1 minute while I summarize, because we have a great offer for you for how to get access to some of these automated tools. So we talked about a couple of concepts that are important: getting your line items rolled into product families, figuring out the right volume counters, calculating a bucket of costs from which you can calculate the average all-in per item cost, and then using that as your basis for comparison. Those are important foundational concepts to be able to do a good job of these things. We talked about looking at your pricing, but not from the standpoint of hunting for nickels on the road, but looking for strategic opportunities to maybe consolidate services, to pick lowest price banks, to look at benchmark information to give you more leverage if you are paying prices that are substantially higher than like the 75th percentile. Eliminating unnecessary services that you no longer need. We do see companies that pay for information 2 and 3 times on the same service, and they don't really realize they're doing it until they look at it. Those are good opportunities to save money, much more strategic, generally a lot more valuable than hunting for nickels. We talked about how you distribute your business across your banks. Is your business too fragmented? Is there value in having more consolidated providers? Can that help you in managing your balances and your cash? Can that help your accounting groups? We talk about getting more value out of your balances, and right now that's a big area because we have sat for 8 years with interest rates near the floor, and now you can really get some much better rates in the marketplace. So making that switch from leaving everything in the banks to actually going back to having a short-term investment program is a good thing to be looking at right now. And finally, we talked about variance analysis, and I told you why so many people are loving that. So I promised a good offer. We are offering, for people who are attending this webinar, 6 months free use of our In-Depth product. There's no strings attached, literally. It's so good, it's easy to set up. We want people to have the value of using this service. So that's why we decided to offer it free for 6 months. To get it free for 6 months, you need to sign up by the middle of September. We'll take information from up to 5 U.S. banks. So if you have 5 or less, we take all of your banks. You need to provide us with electronic information from your banks, either an electronic PDF or an EDI 822, and it has to be at the summary level. Those are pretty much all the requirements. There is absolutely no obligation to continue using this. We just want you to see how good it is to have easy to use data at your fingertips. So back to that question somebody asked, no manual input, all automated. It's very, very easy to get it set up. We will help you set up. So if you're interested at all in this, that person whose picture is on the page, Jill, she is the head of our in-depth sales activities, so feel free to give her a call or send her an email and tell her you want to hear more, you want to get started. Okay. Thank you so much for spending this time with us this afternoon. We're really passionate about using your account analyses better and getting the value out of them, especially without having to get your losing your vision by doing all this stuff manually. So we hope that some of you will take us up on this offer and just see how good it is to have good synthesized data without a lot of hard work to get there. And so now we're going to turn it back to Ann, who's going to close us out. Thank you so much.
Okay, well, again, thank you to both Kathy and Tony for being our speakers today and sponsoring our event. So again, thank you both for being on this call. And I would also like to take this time to thank all the attendees for also being on this call. And I hope everyone has a great rest of your day. Thank you.
Thank you. Bye-bye.